Hi, I'm Michael Cheng. I own 6 cabins in the Smokies, and I use AirDNA to help inform my pricing decisions to maximize revenue. So I'm going to go through some of the market dynamics that I'm seeing in Sevierville, and we'll also address that viral tweet that went around a week ago, Nick, on Twitter, and debunk some of the stuff that he said. So let's actually just dive into data first. Just looking at the occupancy rate, 62% in May, 69% in April of this year. If I look at last year, it was 61% versus 68%. So pretty flat. I know people have seen some people have seen a fairly big decrease in revenue and occupancy. I feel like a lot of it is the new supply that's coming on market. And if you don't have a great listing, you probably are seeing your relative occupancy decline. But look, those new cabins are also getting occupancy as well. I think that's why you're seeing some of the supply and demand dynamic. So I actually go and I download all the numbers here just so that I can run some analysis. And so from a market health perspective, it's actually gotten better in January. So if I highlight here in January and February, it wasn't great. You had demand only growing 15%, but supply growing 20%. So that's really much lower. And sorry, you've had this kind of big imbalance here, which is why you saw a lot of the ADR deterioration. But we're seeing supply starting to moderate here, actually, and demand continue to increase by 15%. So it's good. We're seeing the market starting to balance now. So I do think that as supply starts to moderate and we still have demand growth, the last 6 months will hopefully just be a blip on screen. I don't think it'll be a multi-year event. It might be 6, 12 months, but as long as the supply continues to moderate, we don't get as much supply growth and demand continues to increase 10, 15% year over year, I think that'll be really positive. Okay, so looking at rate health here, rates continue to decline. I think that's what we're all experiencing. People are cutting rates a lot earlier and faster. I think us on the host side are going to see this behavior and hopefully moderate our behavior because you're seeing booking windows collapse so much. So you don't really need to drop your rates so quickly and panic. Like the demand is there. They're just waiting longer to book. So if you wait longer to drop your prices and you have a good property, you are going to get booked. Okay. And then looking at rate tier here. So actually just going back here, you're seeing a steady single digit ADR growth, deterioration overall. And then I try to break that out. So it breaks out between budget. If you break down the data between budget, economy, mid-scale, upscale, luxury, you're seeing that a lot of the deterioration is really in this kind of middle of the bell curve here, right? If you're between economy and upscale, between a $250 to $340 range, like that's where everyone's battling for the same customers. You're seeing kind of luxury hold up pretty well. And you're seeing the budget stuff hold on pretty well. So if you're really cheap or really expensive, you're doing okay. The really expensive stuff is probably very, very rare and people are still willing to pay up for it. And if you're budget, you probably just don't have that much further down to go. But you're seeing the economy tier starting to bleed into budget, and you're just seeing people with okay cabins without a lot of amenities or an okay location all battling with each other. And that's where we're seeing some of the deterioration and some of the angst that we're seeing amongst the owners. So I hope this is helpful. And then just addressing the viral tweet that came out about a week ago. Obviously, we're not seeing 50% revenue declines. Maybe some people are, but as a whole market, I think it's probably single-digit declines. We're not seeing this massive decline that is scaring people about Airbnb investing. In a sense, it actually might be good because it'll moderate some of the supply that we're seeing. That's the ADR drop. And then if we look at actually just overall market revenue here for Sevierville, you can see here, right, this is May. So this is probably, if I count this just very quickly, there's probably 44 million overall revenue. And then I look at May here, right? That's probably 42 million, a 7% drop. Definitely not 50%. If you're seeing a single digit 5 to 10% drop, you're probably it's just the market dynamic, right? And we're coming off a very high base in 2022. Now, if you bought in 2022 and expected those rates to grow, that's going to be a problem for you. And I think you need to think about your strategy and how you want to continue to operate your properties. But if you bought before 2020, 2021 at a good price and a good property, you're probably seeing a little bit of rate decline. You're probably seeing a little bit of revenue drop, but overall it's going to be okay. I hope this is helpful. Please leave any questions in the comments below and I'll answer them. Have a great rest of the day.